If you have $10,000 in your savings account right now, your bank does not have $10,000 sitting there for you. It might have $1,000, maybe less. And this isn't fraud, it's completely legal. It's how banking is designed to work. Most people picture their bank account like a locker. You put $10,000 in, it sits in a digital locker with your name on it, and whenever you want it, it's just there. That's not how it works. When you deposit money, you're not storing it, you're lending it to the bank. In exchange, the bank promises to pay you back whenever you ask, and sometimes pays you a little interest for the privilege of using your money. And what does the bank do with it the second it lands in their system? They lend most of it right back out to other people, as mortgages, car loans, business loans. Here's where it gets wild. In the U.S., banks used to be legally required to keep a percentage of deposits in reserve, as low as 10%, sometimes less depending on the bank's size. As of 2020, the Federal Reserve actually dropped that required minimum to 0% for all banks. Banks still choose to hold some cash for daily operations, but there's no longer a hard legal floor forcing them to. So let's say a bank gets your $10,000 deposit. If they only keep, say, 10% on hand, that's $1,000. The other $9,000 goes out the door as a loan to someone else. But that $9,000 doesn't just disappear from the system. The person who receives it deposits it into their own bank. That bank keeps 10% of it, $900, and lends out the other $8,100. That gets deposited again, loaned again, deposited again. This is called the money multiplier effect, and it means your original $10,000 deposit can eventually create tens of thousands of dollars in loans circulating through the economy, money that didn't physically exist until banks started lending against your deposit. This is genuinely how most of the money in the economy is created, not by printing cash, but by banks lending against deposits over and over. So why is this legal? Because it's the entire foundation of how modern economies grow. If banks only lent out money they had 100% sitting in reserve, there'd be dramatically less money available for mortgages, business loans, and student loans. The stuff that lets people buy homes, start companies, and hire employees. Fractional reserve banking is the system that lets your $10,000 deposit help fund a small business loan across town, or a family's first house, while you still get to check your balance and see your full $10,000 sitting there whenever you want. It works because, on any normal day, only a small percentage of depositors actually show up wanting their cash at the same time. The bank is betting, correctly, almost always, that everyone won't ask for their money back at once. And that word, almost, is doing a lot of work. Because if enough people do show up at once wanting their money, the bank literally cannot pay everyone. Not because of theft, not because of fraud, because the money was never physically sitting there to begin with, it's out in the form of thousands of other people's loans. This is called a bank run. And it's exactly what happened in 2023 with Silicon Valley Bank. Depositors got spooked, tried to pull their money out all at once, and the bank couldn't produce it fast enough because it simply wasn't sitting in a vault. It was tied up in investments and loans. The bank collapsed in about 48 hours. This is also why you'll see signs in every bank about FDIC insurance. That's the government stepping in to guarantee your deposits up to $250,000, specifically because the system is designed this way. The insurance exists because the money isn't actually all there. So what does this mean for you? First, this isn't a reason to panic or pull your money out from under your mattress. Bank runs are rare, and FDIC insurance genuinely protects you up to $250,000 per bank, per account type. Second, it's worth checking that your bank is FDIC insured, and if you have significant savings, spreading it across multiple banks can make sense once you're near that limit. Third, next time someone says the bank is just holding your money safely, you'll know that's not quite true. Your money is working, funding someone else's mortgage, someone else's business, the entire time it sits in your account. Banking isn't a locker. It's a massive moving system, and you're part of it every time you deposit a paycheck.